Hey, what's up, everyone? Welcome to another week of the BYOB Ask Me Anything Happy Hour. We're happy you're here. We're happy to be here ourselves. We're happy to answer all your questions. So get those things over in the chat box. We're going to have some fun today. It's been a wild day. We started out with just the most, I don't know, what would you call the news lately? Just mind-blowing or controversial or entertaining, or I don't know, but we went through that with What the F this morning. Wealth Webinar was another mind-blowing show. I mean, HELOC Joe was there, and Craig was there, and George was there, and Chris was there, and we were talking HELOCs and all-in-one mortgages and infinite banking and how it all works together. Just really amazing stuff. So hopefully you got some good questions that'll come out of that. But we're going to play a quick 14-second video. Be right back to go around the horn, introduce ourselves, and we'll dive into the questions. So it is happy hour. Grab a drink if you're into it. It's Wednesday. Be right back. All right. Welcome back to Happy Hour with the Ask Me Anything, Be Your Own Banker crew. I myself here am playing with a good old-fashioned
Slinky.
Yeah, you know, I mean,
a wonderful, wonderful toy.
I don't even know where I just found this, but yeah, anyway, so that's what I'm up to today. So hanging out down here in South Florida, it's been hot, but actually felt like there's a little break in the air today. I don't know, and there's some waves out in the ocean, so I think some kind of front must have blown through. But other than that, beautiful weather, and it's been a good busy week so far. So with that said, I'll pass it over to Miss Shauna Decker. What's up, Shauna?
Hello, missed you guys last week, so I'm popping in today. I don't know, just here. Don't have anything new to report. I'll pass it over to Brian.
Cool. Hey, Brian Fouch here up in Idaho, but yeah, busy week this week and stuff, and getting ready for our kids to go back to school here in 3 weeks. So, Steven, your kids back now, but yeah, we're end of this month, so kind of crazy. Seems like the summer just blinking went by, but that's the way it is. Linus, go for it.
Hey, thanks, Brian. Linus here from Hopkinsville, Kentucky, like usual. Staying busy, getting ready to actually pay an annual premium on my oldest policy this weekend. So I'm actually kind of excited about that. I've always been on monthly before. So yeah, it's really exciting to look back over the last 5 years and see how far I've come from next to nothing, and now having my banking system capitalized with well into the six figures. It's just, I would have never dreamed. But yeah, those are the things I'm thinking about a lot this week. Over to Jason.
Thank you, Linus. Congratulations, brother. That's amazing about everything you got going on and the progress you've made. Super exciting. And that could be any of you, anybody listening, anybody watching. If you don't believe you can do it, well, just look at all of us. We're examples of what you can do. We've all started different places with different frames, and we all asked a lot of questions. So you're in the right place. I'm still in the city, beautiful, Steven's favorite place in the world. And it is kind of hot in Florida, Steven, and the storms are a little bit wild. So I'm going to kick it over to that guy, Mr. Joe HELOC.
Hello, I'm Joe up in Buffalo, New York with Shauna and Chris, and discuss about HELOCs and IBC and private money lending, and been in real estate for 25 years and here to answer your questions. So bring them on and off to partner in crime, Craig Adore.
Hey, thanks, Joe. Craig Yenny here from the south part of Denver, actually far south of Denver, because I don't want to be known as from Denver. Anyway, Shane knows what I'm talking about. Shane, he's on here. He's always saying he's from Denver. Anyway, we had a good wealth webinar. You know, Joe was there, and like Steven said, Joe and our CMG friends, and just talking about the all-in-one. So if anyone was there and you have questions, you know, put them in the chat box. We'll answer more about those. But yeah, it's always busy. We're trying to help as many people as we can in the process of building this thing you keep hearing called the Vault. The Vault's going to be out and in your hands sooner than you know. But with all that said, I'm going to pass the baton over to our good friend. Yes.
Hey, it's Tess, and just a reminder, I'm that insurance professional accountant for 30 years that decided this process was so amazing that I had to leave that desk behind and come out front. And I'll just say, this is my weekly reminder. Tomorrow is MSTV at 11 a.m. Eastern Standard Time. And this time I'm going to talk about reserve, redundancy, and return premium and why that's actually a good thing. And looking forward to who joins me tomorrow. Linus and I will actually probably both be there tomorrow.
I love that. And then if anybody hasn't signed up for Money School TV, it's really easy. You go to moneyschool.tv. That's where you can sign up. And if you are a member of Money School TV and you're like, oh my gosh, I haven't been on, how do I get back on there to access it? It's learn.moneyschool.tv, and then you kind of log in with your email. So, all right. To or not to bowl. Be or not to be, said PMC Money Tank Orlando purchased a ticket a few days ago and looking forward to it. Who's all going from the team? I am.
Yes, sir.
I'm pretty sure I'll be there.
The only people to Money Tank Orlando.
Yeah.
Right. All of us, like maybe Linus right now and Brian, we got to convince to get there.
That's a long flight.
And then confirmation email will be sent immediately. Yes, actually, if you email me, so Shauna, SHAWNA at Private Money Club, I can send you the room link, and I definitely suggest doing that. It's on my to-do list to book my own room as well, just to make sure that I have it on standby. So email me and I'll give you the room block link. All right. And then Ruth is saying, hi, everyone. Ruth here from Richmond, California. I get a whole life insurance policy. I must get a whole life insurance policy. Please guide me. Which one is the best for Northern California?
She just needs a link. She needs to have a conversation. The one that meets your needs, Ruth, is the best one for you.
Yeah, location doesn't matter in that regard.
Nope.
And then everybody on the screen is licensed in California. So there's this little ticker at the bottom, mentors.beyourownbanker.com. If you use that, anybody that you're connected to on the phone is going to be able to help you. Justin saying, with the all-in-one, how much is the startup process with closing costs again and title stuff since you're transferring the home? I assume it all depends on the price of the home.
There's nothing, well, it's the title insurance and the typical refinance charges. And it's a $1,500 fee to the bank to do the process. And then the appraisal, that comes out of your pocket. Somewhere right around $400-ish, $500-ish dollars. All the other closing costs get rolled into the HELOC. Average, I'm going to give you somewhere right around $4,500-ish total. But that does go in the different parts of what state you're in and such because of different fees.
Hey, Joe, is there ongoing fees for them to do that like thing every night and all that?
Negative.
With CMG, there's a $60 fee a year. Not a big deal, but that's it.
Cool.
Okay. Christian Amar is saying, how much is the vault going to be if we didn't get in for beta testing?
That is still being worked out. So Christian and I are still working on some of the details there, but we're still in beta testing. So Christian, if you are wanting to be in, I think I sent you a login, but if not, reach out to me, Craig at chrisnoggle.com. I'll get you in there.
Yeah, and just to clarify, all the beta testers, are going to become paid users at some point as well. So that's not a lifetime beta test. Yeah.
Yeah. So if you're beta testing, eventually we're going to get to the point where we're done beta testing, and then you can decide if you want to keep it or not, and we'll have some more communication on that. But if you want to get in there now, you can get in there and play with it.
It is kind of fun, so get in there and play with it.
And Tess, did you get my message?
I did. I haven't had a chance to go back in, but I'm excited to get back in there again.
Awesome.
Yeah, Brian Richardson's kind of asking the same question, like, is there a charge for that? So it sounds like there's not a charge at first, and then eventually you will be paying to utilize it.
Yeah, and I would also like to shout out Brian and his wife, Mike Samet, and I had been working with them, and so yeah, we'd love to hear from you again.
All right. David is saying, do I need to be a resident in US or Canada to probably do IBC? I reside in Ireland. Can I open a non-resident bank account to do IBC?
I did a really good video on this, and we actually are redoing it now. The editing's almost done, but it's how to do the infinite banking concept outside of North America, which would be Ireland. And by the way, Ireland's amazing. You're lucky to live there. Beautiful place. But effectively, the whole thing is you don't have the specially designed whole lives in Ireland like we do here in North America, US or Canada. Therefore, you have to use a different vehicle to do that, a different machine to run your money through, which could just be a bank account. And then from there, you can apply the infinite banking concepts. I'm happy to post it in the comments if you want, so you can watch the video and see how it works. But other than that, you just will not have that specially designed whole life available in Ireland. You just have to use the process.
And the answer is yeah. To get a policy here in the U.S. or Canada, you would have to be a resident of one of these countries.
Yeah, and something you said, Brian Fotts, a few weeks ago, it was like maybe 2 AMAs ago, you said like it really is a privilege to do IBC, and that just kind of sheds light on that.
Yeah, I had a client just the other day that was outside the U.S. and wanted to do one. Nothing, had an LLC here, but that was it. And so I said, hey, just stay around the campfire, stay around us, because this is definitely something that we're aware of and trying to work on, because that'd open up a whole nother world.
Yeah, Chris, actually, you're going to one of the carriers meeting next week. Why don't you say, how do we get this over there?
It's not as simple as that. It's government.
Right.
It's almost always the government. In the different ways that life insurance works in their areas is really just a component of regulation.
Okay.
Regulation is to insurance companies what the IRS is to the regular person.
That is true.
And then Chris just put in the chat, it should be a YouTube video link to kind of like how you would do this outside of the US. Dexter's saying, do you know if CMG can do an 80% first lien purchase, or is it just refis, and is it only single family residence?
Purchase and rentals.
Can they do multi units?
Yes, up to 4.
Up to 4.
And then real quick, Linus Brian is saying he can give you a call following this. Ask me anything today or set up a time.
Sure. Yeah. Send me an email. I'm going to have somebody post a link or my email in the chat here in a second.
Okay. Perfect. All right. DW is struggling to figure out how I should pay off the mortgage or invest with my first IBC policy. So IBC to mortgage to HELOC to investments. Is that a bad flow? I don't want to sit on the sidelines for the next 4 years while I pay off my mortgage, but don't want to fully invest and not pay down the debt. My only one at 2.8%, 5 years into a 30-year term. Best way to do both.
A lot going on there.
Yeah,
HELOC simple interest will be less than your 2.8, especially if you're still in the first 5 years, because most of it's still going to interest. Depending on how the IBC policy is built, you're just going to run the money from the all-in-one HELOC to pay off your mortgage, to consolidate all of your debt, to run through the IBC policy, to put into the investment, to create cash flow that comes directly back into the HELOC once again. So every spoke that you have inside the wheel just makes the wheel spin faster and smoother.
That sounded awesome, but I think you'd have to draw that out like that.
Yeah.
That's a lot to unpack with how you just said that.
I had this exact same conversation with somebody today, and I had to sort of visualize it for them
Yeah.
to see it a couple of times. Then they're like, then it finally clicked. Yeah.
I think the easiest thing to tell DW here is I feel you've got the order backward. Like it's not backwards, but it's wrong. I don't think you've got it in the right order there on how to do it. But to really get the right answer to you on how to do that, it would require a call because we'd have to know a lot more about, you know, you're giving us the one rate, 2.8%, and that you're 5 years into it. So don't pat yourself on the back that you got a 2.8% rate because that's only 2.8% if you pay it for 30 years. You're 5 years into a mortgage. So you're heavily in that amortization phase where all the money you're paying to the bank on that mortgage is going to interest, not principal. Where if you had like an all-in-one or, you know, a first lien HELOC, like we taught today on, I don't know if you were on Wealth Webinar, that's going to move you from amortized interest where it's front loaded with interest to a simple interest model that would allow you to use velocity and a lot of other factors to pay that down. But again, it's really, if you're really interested in learning how to do that, get on a call, you know, with Joe, or get on a call with Craig or any of the money mentors who can kind of run the math for you, reorganize the order of it, you know, and then mathematically show you the fastest and best way to pay down your debts, you know, so that they fit your goals.
It seems like he has the tools and he has the knowledge that he wants to learn. So on my calls, you'll ask questions. I'll answer those questions in order to see where you're struggling or where you don't understand, or answer the questions about amortization or simple interest. So there's only different things that you might be off by, but I mean, it sounds as though you have the knowledge. All I do is take the game board, flip it over, and move the pieces in a different direction. That's all.
All right. Teresa saying, is the HELOC only accessible to compete once a year if you do not qualify with one before? I'm not sure what that means.
No, I don't understand either. I mean, when you qualify for a HELOC, you would be able to get it. Is she saying she can only qualify once?
Almost
I think she's asking if she got turned down for a HELOC, how long does she have to wait before she can start again? Possibly.
That's a good guess. Thanks.
Well, I guess I would need to know why you didn't qualify. Did the bank that you went to, did they calculate your DTI before or after doing the HELOC? I mean, there's so many different scenarios here. I mean, if you're on a 45% debt to income ratio and we go up to 80% of the LTV of the house, all of that money, that equity, after paying off your mortgage, after paying off the debt, is already calculated inside of the 80% of the HELOC. So now all of your debt doesn't exist anymore, so it's not on the board. Most banks will calculate it backwards. We do it the right way, as it is all as a debt consolidation mode. So I hope that answers your question of why you were disqualified or not.
In my interpretation of what you just said is that even if you didn't qualify before, reach out and see again, because it sounds like there's different ways to slice it. So
just depends on what the bank did and why they did it, right? Correct.
Yeah, so definitely, yes, reach out and try again. Oops, already had that one. Felix is saying, how much will it affect your chances to do a whole life policy with cash value, paying dividends, and the capability to do loans if you are diabetic?
It depends.
You need to have an A1C of a 7.
Yeah.
And then type 1 versus type 2 and insulin also make a little bit of a difference too. And then obviously height and weight ratio play into it. So
can I make I'm reading a fantastic book right now that Felix, you got to read. It's called Wheat Belly. So I don't know if you're insulin dependent or just diet, regulated with some meds. But if you read this book, Wheat Belly, I really think it's the answer for a lot of people that are diabetic. I'm forcing my mom to read it because she is diabetic. Literally, like, I know they tell you, you're going to be diabetic the rest of your life or whatever. In most cases, they say that, but this book proves that wrong. So you might want to read that. It's called Wheat Belly. Totally off topic, but
No,
if you didn't have diabetes, you wouldn't have a problem getting a policy, and you wouldn't be asking this question. So let's hit the root cause, which is, let's see if we can get rid of the diabetes.
yeah, health is wealth, Chris. And Felix and I connected a while ago. He's working on getting his A1C down, managing, and all those things. So anything that'll help is a blessing.
Fasting.
So,
I mean, if it's just A1C, just fast. I mean, it's a bitch. It's tough, but do like a 3-day fast and then just keep working on the things you are. But if you read that book, you'll know the answer.
Yeah, Joe.
Yeah.
Go ahead.
No, go ahead. I'm good.
Joe, didn't you have some kind of strategy with, what was it, like a raw egg drink that helps to lower that A1C at least temporarily?
we are not doctors, by the way, either. Just so everyone knows, we're not giving medical advice.
Yeah, you're talking about doing the egg 2-week egg diet and just utilizing straight, like meat and stuff like a straight keto. So you could do vegetables. You would be able. I did it. I do it on an egg diet. So I'll do like 3 eggs in the morning. I'll do 3 eggs at night. Throw some broccoli in it, or put in some different kind of vegetables and do it that way for 2 weeks. It takes approximately 2 weeks for the pancreas to clear out all of the sugar. So that's the process that happens during that.
We are all so interesting. I love it. All right. In View Life is saying, what's the number to call and is there a fee?
There's a link right there in the bottom.
Yeah. So that's
no
like,
fee.
we don't have a number because we're on calls all day long. So if you were to call any one of us right now, we wouldn't answer because we're doing this. And when we're not doing this, we're doing a webinar or we're doing a training or we're on a call with another client. So it's not the phone number or the number to call you want. It's that link down there where you can pick any time you want and we will call you on that time. So that's how you do it. It's right at the bottom, scrolling through. If for some reason maybe you're just listening, it's mentors.beyourownbanker.com.
And then just to clarify, is there if they're looking for, because we've been talking about HELOCs and policy, so is there a difference between, if somebody was looking for a HELOC, what that action item would be, and then somebody who's looking for a policy?
Yeah, we can talk to them about it all. We can talk about what they want to use it for, what that looks like, what their cash flow is, their debts. Maybe they'll use it for debt payoff. What the equity in the house is. We'll collect that info, and we can explore whether a HELOC or a first lien is the right way to go, and how that plays with an infinite banking policy. If it's one of those things where we're going to do both, we kind of need to have that plan together going into it. And so we'll talk you through all that. And if it ends up just being, hey, I just need the all-in-one HELOC, we'll connect you with with a company that can help you with that, and you're on your way. So connect with us on that schedule line right there, and we'll take it from there. If you guys want to talk specifically with Joe, I'll put Joe's calendar in there too. I know a lot of people just want to connect directly with Joe, so I'll add that in the chat as well.
Okay. Dexter's saying, if you drop the PUA on your policy to keep then got your affairs in order later, would you be required to do another physical to add PUA back in, or does that even matter?
That's an awesome question. Lennon, you want to do that one?
It depends. It depends. Hopefully you did not drop the PUAs to nothing. You want to keep on the minimum of typically 120 a year in PUA premium. So if you kept up the minimum, it's just a matter of contacting the company and ask how much you can put in now in PUA premiums, not only for the current year, but maybe also some catch up from previous years. You can do all that. If you did fund 0 for a year, most companies are going to, or I know some of them are going to drop the PUA rider entirely to where you do need to go back through underwriting to add it back on. I'm actually going through that with my brother's policy right now, where just happened to skip PUA premiums entirely 1 year by accident. So he's going to have to go back through underwriting.
All right, and then 64 Impala Addict is saying auto loan at 5.75% on a $35,000 balance. Would it be wise to pay this off with the all-in-one? I'm already paying $1,000 a month with interest of $177. Currently, that makes $100 over minimum payment.
Oh, wow. So like, Craig, this is like right up your alley.
Yeah.
Yeah, I mean, the way I'd look at this is, I mean, I'd really want to get more information. Like, what do you have available in your all-in-one? But I think it makes sense to move the car loan into the all-in-one and take control of it. But there's other factors here. I think we'd have a discussion of how much income's going into the all-in-one, how much expense is going out of the all-in-one. So we need to know, really from a velocity banking perspective, what does that picture look like? So what's your cash flow look like? What do your bills look like? And then we can kind of come up with a calculation for you.
What do you think? I want to ask one other. Joe, what would be your take on this one?
I would definitely, depending on if there was an opportunity for me to put the leftover money in the all-in-one, to put into an opportunity to make the cash flow to actually pay for that car. If there's no opportunity for me to put my principal into action in order to make interest to actually pay for the car, then yes, I would utilize the all-in-one to take out the car. And now that will be as the one pot system, because now I'm not segregating my bills. I'm not paying my gas bill with red money, my electric bill with blue money. Everything is in the one pot. Every penny that comes into the house and my bills that go out of the house, now everything that is left in there is going directly towards my principal of what I owe. When you segregate your bills, it definitely will change the output of the difference of when you're doing the one pot system or putting it all in one place. If you have lazy cash sitting in a different spot and not doing anything to take down that interest, you're not being efficient. I usually go with efficiency and utilization.
Yeah, and Joe, I just add in there too. I mean, that is a good strategy where we can take some of that excess equity, put it to work, and then use that to pay, for the car. But it does add one element of risk. So if that investment breaks, there goes your car payment. And so you kind of have to determine, are you a cautious Craig? I don't know. With the name there, I'm assuming you're doing burnouts in your 64 Impala. But, it's like, how aggressive do you want to be? Because if you want to take some of that money, put it to work and have it pay the car, that's pretty cool. That's a neat way to do it. But just realize that adds one element of risk into the picture. But I think between what Joe and I are saying, it just really depends on who you are, your situation, to kind of figure out how you want to run that money.
Mm-hmm.
So,
Love it.
but good ideas.
Teresa is saying, can we chat Brian? Is there a way to reach you to discuss? She was also talking HELOCs as well.
Her question was on the HELOC, so maybe she meant Joe.
Okay. And that's in the chat. And then this person is saying, I'm late to the show, but I wanted to thank you guys for the content. I've watched a few videos that mentioned age times 10 for monthly payments, but I've missed if there's an initial lump sum cost to start the policy.
No, only if you want there to be, only if you want the ability to put a dump in. I mean, when we design these policies, we design them around the amount that the client wants to save. The recommendation that we give is that it should at least be, like you mentioned, 10 times your age monthly. So add a 0 to your age, that's the minimum monthly. But you don't have to put any type of upfront deposit in, and like you'd mentioned, lump cost. The only I'm thinking you're thinking the dump-ins that we talk about. The cost is the cost of insurance, which when we do your illustration, we would show you that because it's basically going to be the deficiency between the amount you put in and the cash value you have available. And you'll see that decline because of the compounding. The cost of insurance, which is the cost for the death benefit, is level in a whole life. It never changes. So from day one to day 101 or 121, I should say, your cost never changes there. The only other cost there are every year is a policy service fee, which depending on the company is $50 a year or $100 a year. And then in the first year, depending on the policy design, it's usually just the first year is the commission. So that's the commission we get paid on that. We get paid on the base, which if you know anything about how we design these policies, because they are specially designed, we reduce the base down anywhere between 60 to 90%. I should start saying with no dump in 60 to 90%. With a dump in, it could be 50 to 80% because there's a difference with a dump in. But we're effectively reducing our commission by that amount. So we're taking 60 to 90% less in commission. So you have 60 to 90% more in cash value. But the difference between the cash value and the premium would be those upfront costs if we were really kind of, I guess, just using your words for it.
And there is
I want to be specific about it.
And there is no fee. I think he was asking, is there a fee?
Yeah, you don't write us a check. We get paid the commission by the insurance company. I was trying to cover all bases because it's kind of broad, initial lump cost. So I unbundled the lump and explained that, but I think we might have missed the whole question.
The thing I would also say is when you're thinking of a whole life premium, like our Nelson Nash tells us, is that it's not necessarily a cost. You want to get into that, Chris? Or you don't really want to look at it as a cost?
Yeah, I mean, cost is only an issue in the absence of value. I say that to everything. There's a cost for everything in life because the one thing I think people have completely backwards, not to get philosophical here, but the people are so focused on cost that they have lost sight of value. The biggest cost in your life is the time you waste. That's the biggest cost because time is the most valuable resource. So when you put cost in front of value, you're looking at it completely wrong, and you need to almost just reevaluate everything in your life because it's not the cost of anything. It's the value you're getting. If the value you're getting is solving a problem that you have and that problem is valuable to you, then the cost is almost, I'm not going to say irrelevant, but the cost is not as big of a factor. But people always, I think it's just because we're trained that way to put cost in front of value. Dave Ramsey is probably the biggest proponent of telling people cost. Dave Ramsey doesn't even understand value anymore. I feel like Dave Ramsey bought a $15 million house, but then tells people he drives a Toyota Camry. Screw you, Dave. No, you don't. You probably got Ferraris in the basement of your $15 million house. I don't know where I'm going with that, but all I'm just saying is, when you look at anything in life, not just the policies or IBC, look at the value it's going to bring to your life first. Then look at what is that value going to cost me, and then say, is that cost worth the value that it brings back to my life?
And he's adding in, nope, don't care about a fee. Was just trying to think of the best way to have the most available during the first 30 days. Thought maybe a big lump at the beginning might allow more availability up front, which is correct.
Yeah,
right?
That's 100% correct. Yeah. So if you did a dump into the policy, let's say you did 10 times your age. I don't know. Let's say you're 30. You did $300 a month and you wanted to dump in $30,000. That would be super freaking efficient. So if you just did the math, that was like 10 times, right? 300 a month. Well, actually, I'm not doing it right, but 300 a month times 12, and then 10 times would be the most efficient design. So if you wanted to see how to design it with the maximum amount of cash value, every single mentor on here knows exactly how to do that with precision, literally mathematical precision. So just jump on a call and they'll show you how to do that.
Yeah, way to take it straight into the good stuff, Chris. I think what I was getting at there is thinking of life insurance premiums as a deposit into your own banking system. But yeah.
Sorry, I went left field, man. You went right, but you're absolutely. But there's no right or wrong. You're absolutely correct. You got to look at it as a deposit, and You know, if you make a deposit into a bank, is that a fee? Is that a cost to you? And everybody would say no, but actually it is. Like, there is a cost for that, and that's not the way people look at it.
Right. And then Justin saying, are there different factors of when to do a HELOC? Like Joe was telling me to be 6 months from my policy. And I forgot to ask why that is when we talked last, or is it just a cushion basically? Like staggering it.
No, you're getting them mixed up. It's not the HELOC. It's the start of another policy.
So there isn't a reason to do a HELOC 6 months away from the policy.
HELOC doesn't matter when you start it, Justin.
But it is nice to stagger your policies just for, not to have a huge thing, unless you want that.
Smarter to stagger the policies, but the HELOC doesn't matter.
Okay, and this is a shout out. So Shane saying Jason rocked Take Back Control Tuesday yesterday. Brian has always been the best that I've seen, but Jason raised his game worth the watch when the replay comes out.
Wow, thanks, Shane. Thanks, Shane.
I love it.
I told Patty I didn't even think I was that good yesterday. So
competition.
That's always the ones that are the best, though. I swear.
Yeah.
Brian's the best.
Well, ask an actor when they do takes. They say the best take is the one that always is the worst. The one they think is the worst is the best.
100%. Dexter's saying, if you mech your policy on accident, would you drop PUA and then just start a new one and check your mail more often next time?
Depends on when and how it's mech. You can reverse it. So it's within.
I'm thinking that he didn't check his letter for a while. Like that's.
Yeah, it's a certain period of time. It's different by company. Can't remember how long it is, but I mean,
I think it's 30 days.
Within 30, 60 days.
Well, if you need help, Dexter, you better reach out to us more than ask me anything. So connect with somebody and then we'll help you.
I don't know if I would drop
get with your implementation specialist immediately. They should be able to help you.
Yeah, that's first step. But like, let's just say it is mech'd and it's permanently mech'd because you didn't check your mail. So, I love that you're taking ownership of that. I don't know if I would drop the PUA, to be honest. Yeah, I would literally look at the policy and I would figure out when does the policy, because a MEC only affects the policy when you exceed your premium deposit. So when you go over your cost basis. So I would look at the policy with PUAs and then maybe look at it without and figure out, okay, what 2 points do I cross over the cost basis in the policy? So then now you've got taxable gains. And then I would do the math on the taxes. And I would say, okay, the taxes are going to be X without the PUA and the taxes are going to be X with the PUA. I'll bet when you do that or have somebody else do that for you, I bet you it will still make sense to continue putting PUAs in. That's just my personal opinion.
I also have a question. If you mech your policy, do you just like pay to settle up and then it's fine, or is it like permanently mech'd?
Well, if you mech it, it's permanent. Yeah. Okay. If you don't take the money out within the allowable time, it becomes a taxable vehicle. But a taxable vehicle is no different than your savings account. So every year in your savings account, and nobody thinks about this and even cares about this, your savings account pays you 3%. At the end of the year, they calculate how much interest they pay you and you get taxed on that. So the policy is very similar, except the policy, you only pay tax on it when you take the money out. So if you take the money out of the policy as a loan, yes, then you would pay tax on it. It's not, you don't pay tax every, I hope I'm correct in saying this, Linus. You don't pay tax every year like you would in a bank because you haven't realized the gain until you take the money out because it still maintains tax deferred status.
Yeah, that's my understanding, but I'm not a tax professional.
Yeah, check with your CPA just to protect myself.
Terry's saying she did it twice the first day.
Exactly.
Yeah.
Terry checks her mail. Good job, Terry.
Your savings. Go ahead.
No, I was just saying, Terry checks her mail. Good job, Terry and Dex. I agree with Chris. Way to own up to it, and I hope you find a solution, bro.
A Mecha is still great. You still have that tax-free legacy death benefit in the future. So, yeah, why not just
don't overreact because you got a mech. It's still, don't get rid of the policy. Don't be like, oh, I got to replace this because I screwed up and meched it. It's still a good policy. Yeah, you got to pay a little bit of taxes.
but only when you access the gains.
Well, that's it. It's only when you access the gains, and the death benefit's still tax-free. So it's still pretty freaking awesome. Hey, listen, if you lived in Canada, that's just what you would be doing anyway. You'd be like, oh, that's just normal.
Yeah.
All right. Barger Bird is saying, working on a first lien HELOC with Harrison George team. How do I incorporate whole life policy? Is there videos you have done, and is the strategy to do one before the other? Thank you.
Wow. Join us next week for the training, the wealth webinar next week, the second of the 4-part series. And we're actually going deep into that exact thing. So next week, 1:00 Eastern for the wealth webinar. You can register by going to chrisnoggle.com. Sounds like you were probably on today. So just get on next week. And Craig had it all prepared for you today, like a Excel ninja and a Vault ninja. We just didn't get into it because it was just, holy heck, was that crazy with the questions.
Yeah, and I would just add it kind of depends on what you're doing too. If you have debts you're trying to consolidate, there may be one plan. If you're trying to invest with some of that, it might be another strategy. So some of that's going to depend on what you're ultimately trying to accomplish. But like Chris said, next week we're going over that on more of a debt perspective. And then we'll be talking about some of the ways to invest that strategy.
And you can catch this week's on replay at the end of the week on Chris's YouTube.
That's right. Doug is saying, how does having a diagnosis of stage 3A chronic kidney disease affect me getting a new IBC policy? I'm a 72-year-old male non-smoker.
Yeah, probably not getting a policy.
Nope.
Yeah,
I've had that one before.
That's probably definitely, kidney disease is definitely going to be a denial. So the only way to handle that, Doug, would be to find somebody else that has an insurable interest there, that you have an insurable interest in, child, spouse, executive in your company, and then they're the insured and you become the owner of the policy and benefit from it.
Yeah, certainly book a call with somebody on our team, and we may, we can look at your situation and maybe have some other solutions as well.
Wendy is saying, what do you say to those who say this is a scam?
They're right. You are right.
Yeah, you're right because you believe you're right. So
Yes.
nobody's going to change your mind. No, I get this almost daily on my YouTube videos. Oh, this is a scam. This is a Ponzi. And my answer every time lately has been, you clearly didn't watch the video at all because you don't understand this. I mean, how can buying a life insurance policy be a scam? That's crazy to think about that, because essentially, if you're saying it's a scam, that's probably why you're saying it's a scam. But the process is simple. It's what you do every single day of your life today. It's the same exact thing. The difference is who you write the checks to. If that's a scam, boy, hell if I knew.
And I think it is education. Even myself, there's a lot of people. I've been around this campfire for over 5 years now, and I'm currently working with someone who's already so excited that they want to get 4 policies, and it was not 3 years ago they were telling me it was a scam.
But you said it was a scam. What are you talking about?
Oh, yeah, I said you were a scam. I came to the because I was going to prove him a scam. And then I left the insurance industry and joined him. So
at least it didn't take you as long as it took Joe to start. And he didn't even think it was a scam. He just thought he was too smart for school.
does that mean I'm smarter than Joe?
Yeah. Well, he wasn't very smart when he wrote the checks for the cars and realized, holy crap, this money's gone forever. Anyway.
I did.
Yeah.
I'll tell you guys, I did think he was a
This is
scam.
true.
I worked
think
in
he is.
the insurance industry preparing financial statements for regulatory boards for 30 years. How did he know something I didn't know? And he did. Dang it. I only regret I didn't know 20 years sooner.
What were you saying, Craig?
I was just going to add, when I hear people say stuff like, well, it's a scam, I mean, it's tough to answer in the context of this gal, but I typically want to know if I'm having a dialogue, well, what is a scam? What's scammy about it? And a lot of times you hear things like, well, you put the money in, you can't get it out for 3 or 4 or 5 years. Well, and that can be true if it's a traditional whole life policy. So I think a lot of the ways to deal with these types of situations is if someone says, hey, if Linus was talking to me, he's like, hey, Craig, that infinite banking thing's a scam. Like, well, tell me more. Why do you think it's a scam? Well, because you can't get your money out for 5 years. Well, then we can provide facts on why that's not correct. Or, think of any of the different objections that we hear. We can provide facts on why those aren't necessarily true. So I would just say ask more questions. Someone thinks it's a scam, ask more questions and get educated.
I still think it's a scam.
I sometimes tell people, even my own family, it's like, hey, I've been scammed for the last 16 plus years because, it's how long I've been, running policies. So it's the best scam I've had. I don't know.
I was just going to say, this is the best scam that I've been doing for the last 5 years, and I hope it never ends.
Yep.
I mean, we're all not even here. We're all AI now at this point, right? Like we're all just enjoying sitting back on a beach, enjoying the Ponzi scam. It's amazing. So
right,
this is all our
rapid fire.
AI.
We got to go rapid fire here on these because we're getting behind.
Okay. Robert Freeman is saying, just want to verify, can I run charitable donations through my IBC whole life policy? My donations are $500 to $700 per month, and I do itemizing using Schedule A. And there was one more that I lost.
Yeah, the H&R Block one.
Hold on one second. There's a lot going on. And an H&R Block representative said I can deduct up to 50% of my income.
There's more to it. So if a 501c3 or like a private foundation owned your policy, yes to all of that, but consult with your CPA and tax professional to make sure. You may want to get a second opinion outside of an H&R Block tax representative. Just saying, no disrespect to them, but if they're just saying, oh yeah, put money into the policy and you can deduct up to 50%, get a new accountant. There's more to it.
I'm reading that a different way because I think
I might be reading it wrong.
I think he's donating $500 of his personal money.
Yeah.
So he's going to take his personal money, run it through the policy, take it out of the policy, and then donate it. So yeah, it's your money. You can run it through your policy, always make dividends and interest on that money, and then put that money into and donate it.
But it wouldn't be tax. It wouldn't be tax deductible running it through the policy until it gets to the charitable donation.
Right. It's tax deductible because he's going to write off that donation. But if he runs the money through the policy, he's just running the money through the policy first and then donating it.
Well, he definitely could run it through the policy. I'm just being clear. Like that's not going to trigger any tax deductions.
Correct.
When you take the money out of the policy and you put it into the charitable donation or whatever that is, the private foundation or
correct,
the charitable remainder, whatever that is,
that's what he's getting in on. True.
Okay. Yeah. I mean, there's a couple different ways we could read into that.
Yeah.
And I just want to throw out there too, because I think people that are new that hear strategies like this where, hey, I'm going to run my charitable deductions through my policy, take a loan and go do my donations. They're never thinking about how do you pay back those loans.
Right. I wouldn't do that. I'm just answering the question, but
right.
That wouldn't be a strategy I would ever recommend.
But he would have to recapture that money back to the policy somehow.
Yeah, but how's he going to do that if he's just donating it?
I'm just answering the question.
I would say have the policy owned by a charitable, like a 501c3, set up a foundation, have the charity own the policy, put the money into the policy. Now it's tax deductible. Then when you die, the charities that you want to donate money to, they get that death benefit. Now, all of a sudden you've done really good in your life. You got the tax deductibility for the money you put into the policy because it's owned by the charity, owned by the 501c3. Then when you die, the death benefit does good because then now you've got a huge leverage that goes to whatever donation or whatever charity you want to donate money to. That's the way to do it. That's true giving.
Okay. David is saying, I have a whole life policy. I did a $40,000 dump in to start, made my first loan to cover costs of my accelerator classes. Awesome. And I am in the education phase right now and eager to get into this process. Thank you, Chris. That's awesome.
Welcome, David.
Congrats, David.
And also,
Awesome.
because you invested in education, make sure your CPA knows that at the end of the year, because you may or may not be able to write some of that off if you did it through a business and some other things. But double check.
Felix is saying, if you want to front load and make it as efficient as possible, is there a number that dictate that, or is it based on age?
Yeah, I'll take this one because I'm working with Felix. So for Felix, with some of it's going to depend on age. So we'll look at different companies based on what you're trying to do, how much are you front loading, so we can look at what the cost of the term rider is going to be for that amount of dump in. And then some of this is going to be based, like, we'll apply once we find out where you're at physically. Maybe you try this new diet that Chris just suggested for his ma today, and you come back and everything's all cleaned up and we can get you rated with a really good rating. But if things change, like if you say, hey, I want to do this, and we design what's going to solve your problem, and then you don't get approved for that for some reason, we will make adjustments. We might even look at other carriers. We'll pivot. And I've had multiple people go to do a larger dump in. It looked really good at standard, and then they became table rated. And so now we were able to do some different things. They're not putting as much dump in, but they're doing standard. They can add additional PUA after the policy is enforced. So that's a lot to unpack, but just know that we're always going to work with you to make sure that it's the best plan for what is available for you.
He added a little more too, which maybe he did go on Joe's diet. He's saying, let's say you have the policy and initially it was done considering you were diabetic, and all of a sudden a doctor finds out you are no longer diabetic. What happens in this case?
Ooh.
Is the policy modified?
It can be. It can be. You can get your ratings changed, and it's usually, I think, like a year period.
1 year.
If you had the rating, like you were table rated, and then you went back and shown that you're no longer diabetic or pre-diabetic, and you improved the rating, you just have that doctor note. So,
and then I think it's not automatic. It's something that is actionable by you. So if that's the news that you got, that's great. And then you should absolutely, get back with your team and figure out how to get that information to the insurance carrier.
Yeah, I've seen somebody go from a table D rating to standard in about a year period. So
I've seen them go to preferred. I've seen that.
Wow.
Yeah, and actually, I've seen it where they got rated improperly, and then they knew that it was wrong, but they dealt with it for a year, and then when they went back, then they got the proper rating because they read the medical reports wrong.
Yeah, my guy lost like 85 pounds or something like that in it. Yeah.
I've got a few rapid fire. And then this one was interesting, is Lauren saying, with the one big beautiful bill, if I buy a car through my policy, is interest a deduction? And I kind of think it might not be technically.
Lauren, that's a great question. And that's one that I was going to deep dive. And then I found out that I was phased out from receiving the deduction on the interest. So I just kind of dropped it. But if you can give us some time, actually, that would make a great YouTube video. I will find out. So here's my initial take on this, but don't hold this as the gospel. I would think yes, because if you're under the phase out limits for that, you're still paying interest. And then as long as you're paying it back to the insurance company, there's a very good possibility it would be. But let me check with my CPA. Shauna, can you remind me tomorrow to get a hold of Mark and I'll ask him, because that's a great question. One I've been meaning to get an answer for, but because it didn't benefit me, because, the tax bill only benefits the wealthy, right? Because we're phased out of everything. Anyway, I'm going to get off my soapbox.
Okay.
How, never mind. I'll wait for you to talk to the CPA. I'm interested in that question too, though.
Me too. That's a great one. Best question of the day.
All right, if I have an all-in-one loan where I locked in my rate for 5 years at 3.75%, and the value of my home has gone up, where I'd like to tap into that equity, would you refinance or open a second lien HELOC?
I actually did this. It's kind of funny. Joe, you know this. I went and I got a HELOC. Okay. And then my house went up in value tremendously. We got another appraisal. And then also my income was higher because some stuff with my tax returns and trusts. So I went back about a year and a half later, and I got an all-in-one, or not an all-in-one, a first lien HELOC. It didn't have the checking account attached, but I got a first lien HELOC opened up took the extra equity out and got lucky, and me and Joe locked in a 3.99 intro rate on that. So yes.
I guess the question
Yeah.
that they're wrestling with is they're currently in an all-in-one with 3.75, and if they refi, they're probably going to go to call it 8, 7.5, 8. And the question would be, is there value in doing that at this point? Like, how much more equity are you going to get access to? And I mean,
Question: could you take out a second lien HELOC when you got a first lien all-in-one?
I don't think you can. Do you
Well,
know?
It depends. Did they go all the way up to 80%? If they went up to 80% on the first figure,
He said his equity went up.
But how much? If we're talking 10,000, 20,000, I don't think that's enough to play with. If it went up 100,000 or 200,000, and then they can take that money and put it into an opportunity to make the difference of 5%, well, then do it. But I would stay at 5 years at 3.75 and keep on utilizing that HELOC to the best of my ability.
You know what? We've got a 4-week series on this. Why don't we table this and ask the actual person who would be able to give us the answer? Because I'm curious. Another good question. So let's ask this next week to Harris and George.
All right, and then we're on rapid fire. Can I open a policy for my niece or nephew?
Yes.
Did you ever make the video with Fantastic for
Yes.
setting up kids' whole life? Okay. Find that somewhere. And then I think that's it.
Well, that was rapid fire.
That was rapid. I was thinking the same thing. Chris said rapid, and then we were going really big.
All right. So let's write down these questions because, we'll forget. So Harris and George, the question was, with all-in-one, can you do a second lien HELOC later? Or actually, the other question is, or could you negotiate or redo existing,
like a credit limit increase?
To increase. Okay, so that's one. Second was the big beautiful bill.
I stayed at a $400,000 HELOC when my house was almost twice as much, up to 750 for like 4 years, and I just kept on utilizing that 400 as much as I possibly could until that new 3.99 introductory rate came in, and then I jumped all the way up. But I wouldn't upset the apple cart at 3.75 for 5 years. I would utilize that and what you have. That's my take.
Okay, great. I got the 2 questions.
All right.
That looks like a wrap. Thanks, everybody, for joining us for another episode of Ask Me Anything Happy Hour, and we will see you tomorrow and maybe the next day. But we'll definitely see you next week, and we'll definitely see you next Wednesday for part 2 of the 4-week all-in-one HELOC deep dive. So we'll see you then. Thanks for joining us.